Hey everyone, this month I am partnering with Questrade and they've got a special offer for In the Money listeners. Questrade is focused on building the future of investing right here in Canada, and they've rolled out some real game changers. We're talking about the new trading platform, Questrade Pro, which is in beta right now for select users. If you want to join the beta group, you can sign up on their waitlist. Now, when it's fully released, you will be able to trade directly from best-in-class charts. You'll have lightning-fast execution. You'll have AI tools, a full trader performance dashboard, and the best part, it's totally free to access. Now, in the first quarter of 2026, you're going to be able to trade assets like real physical gold right inside your Quest Metals account, just like a stock. And then they're first in Canada to make cash-secured puts available in all of your registered trading accounts, except for an RESP. That's a huge, sophisticated income-generating tool now available to everyday Canadian investors. But the one that really floored me was their 2026 announcement for custom indexing. You can take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? Use my special promo code INTHEMONEY, all one word, when you sign up for your first self-directed account, and you'll get $50 as a cash reward. Or you can open up a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com. Remember, promo code INTHEMONEY.
Welcome to In the Money with Amber Kanwar. I'm Paige Ellis, and I'm in for our special series on alternative investing. In today's episode, I sit down with one of the most influential voices in global alternative investing. Brookfield's Sachin Shah has spent more than 2 decades inside one of the world's largest private market firms, and he joins us for an in-depth look at the future of alternatives, why private markets are finally moving mainstream, and how everyday investors can tap into opportunities that were once reserved for pensions and sovereign wealth funds. Let's get into it.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca.
Sachin, thank you so much for joining us. We're so happy to have you in studio.
Yeah, thank you for having me here.
Of course. So I want to start by talking about your career. If my facts are straight, you joined Brookfield in 2002.
Yes.
Right around the same time as the CEO, Bruce Flatt.
Yes.
Correct?
Yeah.
Really interesting time. I mean, it was, shortly after the dot-com bubble burst. 9/11 was barely in the rearview mirror. We know that Brookfield had just launched its first private equity fund maybe a year earlier.
That's right.
What was it like in those early days?
Very much like it is today, oddly enough. That sounds like a crazy answer, but very entrepreneurial, very value-driven, very much a focus on long-term investing, compounding capital, and investing in areas where, even at that time, where we felt we had some level of expertise beyond just investing, but even within the operational elements of a business. And I would say being a part of it then, you don't think of it at the time of what the future will look like. But when I look back today, it's going to sound crazy, but the basic tenets of the place, that value investing, capital compounding focus, is all still there and has been transferred down through the next generations.
And you're kind of alluding to this, but what were some of the lessons you learned in those early days? You hear that these formative experiences as an investor stay with you. What do you still do that you kind of learned back in those early days?
I would say the biggest lessons we learned were invest for value. And if you invest at the time when maybe others are afraid to invest or things are out of favor, but you have the skill to create value around it, you have such a significant margin of safety when you put money to work that way. And you have the ability to compound capital, and business is cyclical, investments are cyclical, and when things come back in favor, you will have created tremendous value. And I think we do that in all the areas that we operate in. It doesn't always work perfectly. You can't time the market perfectly. But we are value investors at our core. We're very careful on leverage. We are always aligned with our partners. We're aligned as a management team. We are heavily invested in the stock ourselves. We make sure we're heavily invested in our transactions through our funds. We sit side by side with our partners. So that, I would say, those are the things that we learned over the years that we've just gotten better at, and we have made sure that we haven't lost it in the organization.
So you have lived and breathed private markets for a few decades now.
Yeah.
But retail investors, our listeners, our viewers, this is a fairly new, broad asset class. So how would you define alternatives in 2025?
The way I would look at alternatives, historically, alternatives were available for the institutional class of investor. I would say in the very early days, it was driven by private equity investing in companies directly. It evolved into real estate, into infrastructure. We took it into renewable power as an organization and really created a leadership position there. But it's really investing directly in businesses or assets rather than the stocks of those companies. And when you invest directly, you own a private interest in a company or an asset, which comes with both great benefits, but also some things you have to be mindful of, like liquidity. And the benefits, though, over time, if you're a good investor, are highly compelling. One is you don't have to worry about the vagaries of the quarterly market cycle. You can incentivize your management teams for a very long period of time. You can make decisions that are, even though this sounds very logical, decisions that are solely for the best outcome in the long term for that business. Sometimes the public markets just are a distraction. And I would say what has been proven over that period of time, the last couple of decades, is private market investing is consistently reliable, generates outsized returns, offers compelling investment opportunities that don't always make themselves available in the public markets. And for retail investors to be able to get exposure to that at the exact time when in Western society people are aging and need to plan for their retirement, I think is both very important and something that should not get lost on the advisor community. They should really be pushing for investing in alternatives for their retail clients.
Why in the last 5 to 10 years am I hearing this from everyone? Private markets. Why has it gone mainstream? Why is Main Street now talking about it?
I think things naturally take time. It was only 20 to 25 years ago that institutional investors were not investing in private markets. Most large pension plans, endowments funds, sovereign wealth funds, they were stock and bond pickers. They invested in public securities. Then they started to allocate a small amount of their portfolio. They saw the success. They grew their allocations. They then said, we want more private assets. I think it just takes time. And I think what's played out is institutions who have invested in private market assets for the last 2 decades have had excellent results. And people talk about that. And it's allowed sovereign wealth funds to be the largest investors on the planet. It's allowed our pension plans here in Canada to be meaningful forces of capital around the world. And all of that makes its way into the mainstream media, which then starts to make its way into the mainstream dialogue. So I look at it in part, it needed to season. It needed to demonstrate that it was reliable over a long period of time. And now it's truly ready for retail investors.
Mm-hmm. So let's talk about some of the ways that you're deploying your capital right now. You have, I read, something like 2,500 investment professionals in all the key markets around the world. So where geographically are you seeing the greatest opportunity right now?
The U.S. is still our biggest market. Half of our investments are in the U.S., but we're in over 50 countries around the world. We have investment professionals all around the world. But just given the scale and size of the U.S. market, that still is our largest market. But we're in Europe, we're in the UK, we're in Latin America, we're in Asia. India and China are big markets for us. And I would say all of these places have investment opportunities that fit the things that we do in the asset classes that we pursue.
Mm-hmm. Are there specific jurisdictions that you think are kind of getting it right in terms of creating an inviting opportunity for investors like yourself? And I guess on the flip side, are there jurisdictions that you feel are just getting it all wrong?
I think what I would say is we're in a place in the world where, on balance, governments don't have the fiscal balance sheets to invest in long duration, critical infrastructure, backbone economy assets. And I would say when they get it right, they open up their economies to private sector investments. Their banks and international banks provide capital. The regulatory frameworks are there to protect consumers, but still ensure investment gets done. And we choose our markets based on that. Where we are is in countries that have those features. And where we're not, we don't feel comfortable that exists. We have a number of criteria internally that we use to assess where we're going to invest. But like I said, those are some of the basics, that sort of real respect for capital, an open banking system, rule of law, that allows you to invest for a very long cycle. Mm-hmm. And I think, again, I look at where we invest today. The U.S. is such an important market for us. It's a very, very large market, and our investments there are probably half of the overall business of Brookfield.
Mm-hmm. And the recent tariffs, how did that affect your calculus?
Tariffs, and I'd say government policy in general, because we invest in things that are so long-term in nature, mm-hmm. we're always planning for changing policies, changing regulation, cost structures changing. Fundamentally, though, that doesn't change the level of demand and supply that's needed for that underlying asset class. And as long as you're investing based on first principles, is this asset class or this business going to create a product or good that's needed for many decades to come? Do I have the operating capabilities to create value over a long period of time? Have I capitalized it properly? Do I have a management team that's incentivized properly? If you've got all those ingredients in place, you can weather the storms of small changes. So you can have tariffs come and go. Mm-hmm. You can have government incentives come and go. You can have regulation that also changes your ability to deploy capital. But where we invest, because it's critical, what we call backbone economy assets, you can't stop delivering that service, and governments understand that. Mm-hmm. Also, much of what we do is not really like importing and exporting of goods and services. So much of what we do is localized. We'll own buildings, we'll own utilities, we'll own power wires and power plants. It's serving the local markets. So although tariffs are there in the background, they're not really impacting our ability to deploy our assets to the local economies that we serve.
In terms of specific asset classes, is there an area that you see a lot of mispricing happening right now?
Well, the obvious one is real estate, right? We've been a real estate investor a long time. We've learned that real estate by its nature is cyclical. We've learned that when the cycles are in a downturn, you need to have the best and the highest quality assets in the best locations in the world. And you need to have the balance sheet to be able to withstand temporary declines in value or demand. And if you can do that, which we have done at Brookfield through multiple cycles, you'll come out the other end with tremendous value creation. I look at real estate today. In most major cities in the world, nothing's been built for the last 5 years, which means the next cycle will have a scarcity of supply.
Right.
And for those people who weathered the storm in parts of real estate, it could be a tremendous opportunity.
It's so interesting because I listened to a recent podcast with Bruce Flatt, CEO of Brookfield, who said, and I'm kind of paraphrasing here, but he said, the fundamentals in real estate are really strong, which I found such an interesting statement given all the headlines we're seeing about real estate these days. He then continued, the issue is there are capital structures not built for today's rate environment. Can you help us tease that out a bit? Do you share that view, I guess, to start?
Absolutely. The fundamentals, as I said, are very strong because nothing is being built. Comes down to leverage, which I think the point he's making is if you run your business with too much leverage because you don't appreciate that the business is inherently cyclical, and therefore you're not prepared for a cycle when capital stops flowing to your asset, you will get caught out. And I would say because we've been investors for such a long time and we've seen these cycles ebb and flow, we're very focused on investment grade capital structures. We're focused on leverage that's ring fenced at the asset and doesn't come up to the corporation. And I think what he's getting at is what allows you to survive and thrive in business is building a fortress-like balance sheet and having a lot of liquidity around, making sure your capital structures at the asset level are thought through, knowing that cycles change. And we have spent decades at Brookfield doing that. And it's why when these cycles come, we're not in survival mode. We're in the mode of how can we prosper here? How can we put money to work? And that's been our, one of our ways we've been able to be contrarian for a long time.
Okay, so contrarian. Are there areas where you're feeling cautious? Are there areas that you think are too crowded right now?
I wouldn't say crowded per se. We've come out of a very interesting 5 years. Inflation, rates going up, valuations are, very full in many parts of the world. And if you look at the stock markets on a tear every day, I wouldn't say necessarily cautious. I would say we're careful not to chase ever increasing multiples. Again, it comes back to, can we invest in businesses or assets where we have some inherent operational capability and where we think we can acquire for value? And that might mean that there's times where we're just not putting as much money to work. And we're okay with that. We'll be patient. But yeah, I would say, are there parts of private credit that we're being cautious in today? Yes. Not all parts of private credit, but certainly a lot of the types of loans that were migrating off of bank balance sheets into the private credit cycle. Yeah, we pulled back from when we stayed. We were careful in those areas. But there's other parts of private credit where they're focused on long duration real asset investing that are great because there's not that much competition and we can generate spread and returns. So I would say we're being very nuanced about it.
And private credit has been in the news a lot recently because of the First Brands bankruptcy, which of course, First Brands an auto parts maker, my understanding.
Yes.
How are you stress testing your investments to make sure that you're not, going to encounter a First Brands type situation?
Look, that's where I would say the size and scale of Brookfield and the people we have, the diligence we do, is very careful. This was a situation that was, there was unique challenges in this situation that I would say can happen, but we're very careful. We do a ton of diligence, and we like to invest where we have a base of internal knowledge that allows us to assess risk. We often talk at Brookfield about operational expertise. The reason we make such a point of saying we want to be operators, we want operational capability, is it doesn't always lead to higher returns in the long term. What it often does is mitigate your downside. So when risk comes into the system, the fact that you have your hands on the operations means you can protect and weather the downside. So it's a great risk mitigant more than it is potentially a value lever. If you get both of them right, that's the perfect situation. So in a situation that you're talking about where we don't really have the operational depth in that area, that would be almost an easy way for us to just step away, not knowing that there was maybe something more nefarious occurring.
So I was kind of debriefed on your investor day, which happened fairly recently. I think it was at the Shangri-La in Toronto. As you're talking about the sort of the First Brand situation, it just calls to mind this comment that was made about how there are some, I think 7,000 to 10,000 PE firms in the US right now. Was it Bruce who said this?
Yes.
And he figured that's about 4,000 PE firms too many. How's this going to resolve? We're going to see PE firms go belly up?
No, I think, and look, I can't speak on his behalf, but I think the point is the large institutions around the world who have been investing in alternatives for the last 2 decades are increasingly consolidating their relationships around large and global firms who have a long track record and who can offer them products in multiple asset classes with a very strong track record behind them. Not every PE firm can do that. There's probably thousands of PE firms who are just subscale and don't have the product offering across real estate, across infrastructure, private equity, energy, credit, all the things that we do at Brookfield. And therefore, naturally, there'll be consolidation in the sector, which is a good thing. Every sector goes through consolidation, in part, in this case, because institutional demand will require it.
But does that mean there's too much money chasing too few deals?
No, I don't look at it as too much money. I just think that there will be PE firms where they're just unable to grow. They're not getting the money that's out there. Or they're not getting it in terms of the scale you need for this business to generate proper returns. So I don't view it as, it won't all of a sudden mean the supply of money goes away. It just means that today the supply of money, which is what it is going to fewer and fewer firms. And so if you're subscale and you don't have the product offering, you're just not getting that money. And therefore, your ability to exist in a profitable way over a long period of time will be difficult.
Is there an asset class that Brookfield has steadfastly avoided? An alternative asset?
There's stuff that we're not very good at. I would say steadfastly avoided is maybe a strong term. We try to keep an open mind on everything. Everything that comes in, we try to keep an open mind, but we're also very realistic that are we good at this? There's people who are good at investing in sports teams. That's not us. We just don't have that skill set. And there's many reasons why you might not be good at something. Often, though, because we're such fundamentally driven investors around, cash flow analysis and looking at balance sheets and doing things like that, we've stuck to businesses where we feel we can actually do real diligence and where we can have good visibility about the long-run stability and growth of a business. Businesses that don't offer that, I would say we struggle with and we don't venture into them.
So I wanted to ask you about the growth of some alternative fund vehicles. So we're seeing these evergreen funds crop up lately, also known as open-end funds, where people can invest and there are exits, shorter term exits than a closed-end fund. What do you make of these products?
Many of these are geared towards high net worth investors, the retail market. I think this is just the beginning of retail investors coming in. This will grow. It's very good for retail investors. It allows for some level of liquidity, which is always what retail investors want. And for retail investors to go from the public markets where there's daily, almost second by second liquidity, to an open-ended fund where there's periodic liquidity is an important bridge to getting them comfortable with private market investing. So I'm a big fan of open-ended funds and its ability to attract retail investors around the world.
What do you make of some of the criticisms we hear about, not necessarily open-end funds or evergreen funds, But just around educating the client, yes, it's more liquid than a closed-end fund, but your capital is still tied up for a period of time. And this is a generation of investors who have been raised on instant data, liquidity. A lot of transparency, quarterly filings. These don't necessarily come with these types of products.
Yeah, well, and look, I think it's in part why most of these funds are today being sold to high net worth investors. And that comes with it all the accreditation that's needed to ensure that they understand the difference between, second by second liquidity versus periodic liquidity. And they also have the financial wherewithal that periodic liquidity is okay for them to plan their life affairs. Again, the benefits of private market investing are all the things I laid out earlier, that you do not have to have companies or businesses respond to sort of quarterly market cycles. The drawbacks could be liquidity, and therefore it's really important that as retail investors migrate into this space, they understand that you really should be coming into this recognizing that you have periodic liquidity. I do think, though, there'll be innovation in this whole sector where there will be secondary markets that open up to allow liquidity. And there will be pools of capital designed really to allow, on a secondary basis, these positions to trade hands and almost mirror daily liquidity like you see in the public markets. All the innovation will come. As soon as you have a dearth of retail investors enter this market, the innovation will follow behind it.
There's been a lot of talk recently about allowing investments in alternatives in retirement plans like 401ks. How do you expect the regulatory bodies to respond to that?
I think early indication is that the regulators, at least in the US, and I would say here in Canada as well, recognize that there is a very meaningful retirement deficit that's been built up into society. In the US, our estimate is something in the range of $14 trillion retirement deficit. Like, these numbers are enormous. And it's in part because 30 years ago, companies started to stop offering defined benefit plans. Everything went to DC plans. And therefore, what's needed for people to retire versus what's actually in their savings accounts don't match up anymore. And one of the ways to bridge that gap is to offer employees who are approaching retirement age higher yielding investment opportunities. Alts fits that very nicely. And the lack of daily liquidity is actually not a real issue because you need that money for the next 25, 30, 40 years of your life. It's not like you need it tomorrow. And so I think what we're seeing is actually the regulators in places like the US and here working hand in hand with the financial community to ensure that regulation is designed to protect consumers, but also to recognize that this gap has to be filled. And that alts, and I would say alternative assets and insurance products are the two key areas that will come together to really help solve this retirement deficit. What I mean by that is, in the old days, you would have somebody having a portfolio with 60% equities and 40% debt, all public. Over time, it could be that you have 30, 30, 30, and the last 10 is insurance. So 30 in alts, 10 in insurance, and then 30 in stocks and 30 in bonds. So it sounds like a meaningful shift, but it will help increase the overall yield of the portfolio. It'll also help provide guaranteed income in your post-employment years through insurance products. And look, my view on this is that's a huge benefit to potential retirees. If you could retire and the last 10, 15 years of your working life, you generated higher returns because you had exposure to alts. And then when you retire, you could get put onto an annuity, which basically decumulates your assets until you die. It solves many problems. It almost recreates a defined benefit plan for individuals, which companies couldn't afford to do 30 years ago. And maybe through the combination of alts and insurance, we have a chance to building something similar to that. So regulators, I'd say, are on board. They've been supportive. but naturally they're going to want to make sure there's consumer protection, which is what they should do.
Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
And I want to get back to the insurance business because you actually started that at Brookfield,
Yes.
and that is, certainly your specialty. But I do want to bring up some of the criticisms that we're hearing in the industry around the push for the retailization of alts. One is, and you mentioned that the reason why alts are going Main Street is that it had to mature. It had to, I think the word you used was it needed to be seasoned. We are, although, hearing critics suggest that the reason why institutions are trying to tap retail investors is that the institutions are tapped out. Is that true? The capital is just not there, and that they need, that massive pool of capital that the retail investors have.
Yeah, look, we're certainly not seeing that at Brookfield. Our funds are growing. The allocations coming in from institutions are growing. So I would say we're not seeing that. I know that's a narrative that's out there. I would look at it this way. At the end of the day, even these institutions who invest in firms like Brookfield, who are they serving? They're serving their retail clients. Pension plans bring money to us because they have pensioners. So we were always in the business of serving retail clients. We were just doing it through an institutional group that just had the fiduciary responsibility to look after a group of people. Whether those were teachers or whether those were municipal workers, they were coming to us and saying, we have a group of people that are going to retire in 30 or 40 years. Can you help us generate the right returns? I think what's evolved is there's a lot of people who don't belong to those types of programs. It's only natural that they get access to the same thing. So, we use the word institution as though it's some sort of nebulous, blob, to use a really unofficial term, but they were always just helping Main Street people. And for this market and for what we do to evolve into offering it directly to those people who didn't have access only seems logical and fair. And my view is it's not because one pool is shrinking. The whole pool is people, and the whole pool is growing. And it's growing because people's savings are growing, but their need for money in later life is also growing. So if you get my point, we're serving the same people. It's just that we've now added people who didn't get to be part of that institutional pool.
Well, quite. And as we, people talk about the democratization of private markets, as that unfolds, how do you see that affecting management fees? I mean, fees are typically, materially higher in private markets versus, your sort of standard public money manager. How do you see this playing out?
I don't know. I think the fee discussion is, to me, it's always been a little illusory. It's one of those where, in the end, I think that what it comes down to is what are the returns you're generating, and I would start there. And I think, like every part of the financial world, what's most important that fees are transparent. That was always sort of the requirement, that fees are transparent, they're well known. And to me, every advisory firm out there charges what they charge, and people should decide based on who they think is going to generate the best overall returns for themselves, who has a track record in doing it well, and who's aligned. Coming back to that cultural point, we made a great point very early on at Brookfield to always be aligned and invest a lot of our own money side by side with our LPs and our partners. And that was to demonstrate that the investments on their own had tremendous merit and had the ability to generate better returns over a long period of time than that you could otherwise get. So I don't look at it with that lens.
As I, spoke to people about this episode and this series we're doing, one thing that kept coming up was, I have to say, a great deal of confusion among would-be investors, I guess, around how people like yourself value an asset. You know, so many retail investors are used to an asset being sort of negotiated daily on the public markets. That's just not how it works in the private world. And I think people, you know, occasionally suspect shenanigans happening. How do you value an asset? Help us understand.
So we, and I suspect many in our world, value an asset based on a discounted cash flow of its future earnings. And I know that sounds overly simplistic, but that's actually how it works.
Right.
We look at an asset or a business, we project out what we think that business can earn over a long period of time. We discount it back at a rate that we think is an appropriate rate that we should earn. And that's the value that we want to pay. And there's times in the market where people believe their asset is worth much more than that. We don't acquire the asset.
Mm-hmm.
There's times in the market where assets trade at much lower than what we think it's worth. And that's the time when we should transact. If we could buy at a discount to what we think it's worth. So we use that word intrinsic value all the time at Brookfield. And our whole objective is, can we acquire assets at below their intrinsic value? And I would say that's not a novel concept, nor is it something that we're the only ones who do. But that's sort of the first principles of valuing an asset.
Mm-hmm. Okay, that's helpful. Simple is always good.
Yes,
I like simple.
Simple is good.
I wanted to talk about the insurance business. You started it at Brookfield, if I have my facts straight. How did the insurance industry respond to private equity entering the fray?
You know, I'd say if I look today, most traditional insurers are now partnered up with private equity. So that tells you how they responded.
Mm-hmm.
They looked at it as initially, anytime you have competition in a space, people are maybe a little worried about what that means. But the traditional insurers very quickly embraced alternative asset managers coming into the space. You know, we're a little different because we didn't come into the space with third-party capital. We used all of our own balance sheet capital at Brookfield to build the business. So we're not private equity per se.
Mm-hmm.
But we were a new entrant, no doubt. And I would say, look, we've had a warm reception.
That's great. I was also reading that Brookfield Wealth Solutions, of which you're the CEO, is looking to grow its business by something like 5x. Is that in a few years? Is that right?
Yeah, I don't know if it's 5x. I would say we started with basically nothing in 2020.
Mm-hmm.
We will end the year at about 180 billion of assets.
Oh.
We'll generate north of 2 billion of free cash flow a year in the business. And we have a business that probably is worth, using a discounted cash flow analysis, somewhere in the $25 to $30 billion range.
Wow.
So we have a really compelling arm of Brookfield that's creating value for our shareholders. Shareholders who've participated with us over the last 5 years would have benefited from that value creation. And I think realistically over the next 5 years, we could take that business, get to 350 billion of assets and 5 billion of earnings. Now, a lot of things have to go our way. We have to do the work. We have to execute.
Mm-hmm.
But we feel like we have a very good trajectory ahead of us. We are serving this retirement market, which is a growing market. And we've got the investment side of the house that allows us to generate very strong returns with the float. And we've got the distribution side of the house, which allows us to write policies to individuals to help them retire comfortably with income for life or income for a long period of time. And that's really the business we set out to build. And I'd say we're halfway there.
Where do you see the biggest vectors for growth? Are you looking more at acquisitions, annuity sales?
It started out through acquisition. That's how we grew initially. But it was very important to us to have both working for us. One of the things we've learned over a long period of time is you want to have both a buy and build mentality, and you want to be able to pivot between the two depending on where you see value. So buying is acquisitions, building is building the business through organic growth, annuity distribution. We're very fortunate that we've been working extremely hard to build out our annuity distribution capabilities. We can do now $35 billion a year of new money annuity distribution in the business, which is a large sum of money that comes in the door on an annual basis. And that means that in a way, with our distribution, if you run it at full scale at 30 to 35 billion a year, that would be like acquiring a $30 billion company every year and bringing it into the system. So we have both, and I'd say we're nimble. If we see opportunities to acquire a company and we think we can do it for value and we can create value with it, that's a good use of our capital. If, on the other hand, companies' valuations are higher than we like, then we use our annuity distribution capabilities and we can still feed the business and grow. So we're in a really fortunate spot in terms of the ability to toggle between the two.
Mm-hmm. What about the AI build-out? I read that Brookfield sees the AI build-out as something like a $7 trillion opportunity over the next 20 years or so.
Yeah.
What will be the Brookfield niche? What will be the Brookfield specialty in that?
That's a great question. We've been investing in data centers for the last decade, and we've been one of the largest investors in data centers. And at the end of the day, I think when you look at what Brookfield brings to that sector, it's the fact that we can bring all of the great things of Brookfield together to serve what is a market that should grow for the next decade or two pretty comfortably. And what I mean by that is, what do you need when you build a strong data center? You need the ability to bring your real estate people to bear, land, entitlements, development, building construction. You need to bring enormous amounts of power. And you need to bring that power in that's both base load, peaking. You need storage capabilities. We have a renewable power group. We own Westinghouse, the nuclear company. So we can bring power and we can bring it in a very localized way. And then we have our infrastructure people who have actually been the ones running the data center strategy for the last 10 years. And the fact that we have all of that in-house allows us to be strong operators, allows us to be developers, allows us to understand the value of location, where you're going to site these facilities, and to be able to partner with the large hyperscalers where we have deep relationships that have been built out over the last decade. It makes us unique in this space. And I think we're extremely well positioned to capture a meaningful part of that market share.
Mm-hmm. How does this build out compare to the fiber telecom build out of the 90s? Is that a useful template?
Maybe. What I would say is what's unique about this is it combines elements of that along with elements of internet adoption and people really using the internet in a way that's much more meaningful than even it was back then. Back then, you didn't really know how much people would use the internet. Today, it's totally ubiquitous. Everybody uses the internet for everything. The scale and the power and the data capacity that's needed for AI to basically become part of everybody's everyday life, I think is going to be multiples of that.
Do you use AI every day? Are you on ChatGPT all the time?
Every day.
Every day?
Every day.
What are you asking it?
I use silly things like how many calories are in the meal I'm about to eat. Like just silly stuff. But I use it like an assistant.
Right.
And if I'm reading an article, I read the newspaper, read many newspapers a day. If I don't understand something, I'll then drill in, and it allows me to. I don't believe everything I read, but it allows me to drill in and just get another perspective or to aggregate information. I also use it just to see how much I can push the boundaries. Like I asked it over the weekend to email me something and it broke down. It couldn't email me. I've asked it before to book a restaurant reservation. It couldn't do that.
Interesting.
But the fact that you can think of these things means it's all coming.
Mm-hmm.
And that's what's exciting, is that today it's still very rudimentary. It sort of just aggregates the internet and gives you information. The fact that it can, in time, will do things for you is, I think, what it captures people's minds.
So I want to close out with a few, just a handful of questions. I wanted to know if there's anything that kind of keeps you up at night around where we're headed with alternative investing, private markets, the retailization. Is there anything that worries you?
No, is the short answer. Look, I'm always excited about the future.
Right.
Always excited. But more than excited, I think, again, coming back to the culture and sort of that element of how Brookfield is built and how all of our people are, trained to operate, we're always thinking about protecting the downside, aware that cycles happen, being prudent with our balance sheets, and therefore cycles will come and go. And our job is to be prepared, not just to weather the storm, but to actually be able to thrive in that period. And that takes a lot of work. It takes a ton of discipline. It takes years and years of dedication. And you don't always get it perfectly right. You don't ever predict the cycle perfectly right. But it does allow us to build in enough cushion that we're not sitting there thinking, what are we staying awake at night? What could go wrong? We're thinking, okay, when things go wrong, as they inevitably do, are we positioned to be able to capture opportunity? Do we have the balance sheet? Do we have financial wherewithal? Are our businesses protected? Do our people know what to do in those situations? That's just a different mindset of how to think about it.
Mm-hmm. So if you were sitting across from someone who had zero private market exposure, what would you suggest? Where would you suggest they even start?
We have a great infrastructure product that's in the market. We have a private equity product that just came into the market. I would say that if you're an investor today, ask your advisor to get you exposure. Our private equity market is in the market right now. Our infrastructure market comes to market very regularly. I would say ask your advisor to come in and start small. Mm-hmm. And if you feel like you can understand what we do, which I think you will, if you feel like the things we do are, enduring assets that form the backbone of the global economy and that will be around for decades to come, and you could compound your capital for decades to come, and that's what you want to do, then get some exposure to our funds. I know that sounds like a commercial, but I think people will be rewarded for it, and they'll be better off financially over a long period of time.
Mm-hmm. Final question for you, Sachin. Is there a trend in alternatives that you think is going to look very different in 5 to 10 years?
Wow, you've stumped me on this one. No, because I think the real trend of alternative investing is you have to always evolve. I don't think you can ever get complacent. I think what I've learned in the last 25 years is what stays the same is your core principles, what you're good at, the foundational ways you invest, and how you protect the organization. What constantly changes is you have to evolve with the world around you, and you have to evolve your teams and the way you approach asset classes so that you're not just doing the same thing all the time. That will always be there.
Mm-hmm. Thank you so much for joining us.
Yeah,
this was
thank
such a
you
great
for having me.
conversation.
I appreciate it, Paige. Thank you.
Thanks to everyone for watching our special series on alternatives. Amber will be back on Tuesday, January 13th with a brand new episode to start the new year. She'll be talking to portfolio managers with billions under management. You don't want to miss what she has in store. Thank you so much for watching.